Nothing But the Truth. Hello, I'm Raj Chengappa from India Today and your host for Nothing But the Truth. This is my weekly x-ray of key issues that matter to you without holding back on the truth. In this episode, we will focus on the good news coming from the Indian economy, which posted an impressive 8.2% GDP growth for the second quarter of FY or financial year 26. It is the strongest macro numbers in years, and Sanjay Malhotra, Governor of the Reserve Bank of India, the country's central banker, chose a fairy tale phrase that caught national attention when he talked about this phase of the economy. He called it the Goldilocks period. Now, essentially, it refers to an economy that is neither overheating nor underperforming, but striking that rare balance between growth and price stability. And that is what the Indian economy has done. And in an exclusive interview with India Today magazine, the RBI Governor explained that the Goldilocks phenomenon is an uncommon combination of high growth and low inflation, and therefore a sweet spot for the Indian economy. Now, the governor's optimism is very well placed. With the Indian economy, as I'd mentioned, averaging around 8% GDP growth, it has outperformed all forecasts, including that of the RBI. Growth has broadened beyond the services sector into manufacturing, and we have seen consumer demand revive sharply during the festive season. Inflation has fallen to levels not seen in years. Now, for a world grappling with trade tensions, geopolitical stress, and volatile capital flows that we've all experienced, India appears to be an outlier. This development, mind you, is not a fluke or accidental. In his third term, Prime Minister Narendra Modi has moved decisively to boost consumption through tax relief that we have all enjoyed, GST rationalization, and again there we've benefited, and major structural reforms. Meanwhile, the RBI under Sanjay Malhotra, who took over as governor of the RBI in December last, has cut interest rates by a phenomenal 125 basis points, the highest in the past 6 years. The Repo rate, as it is called, now stands at 5.25%, down from a high of 6.50% a year ago. It is an unusual move made possible by an unusually benign inflation. As a result, and as bank begins to lower the interest rates, cheaper credit is beginning to filter through the system, and it has altered saving behavior, it has encouraged risk-taking, and eased conditions for both businesses and households like you and me. Yet, beneath the headline numbers lie questions that refuse to go away. How durable is demand once the festival spending fades? And that's not very far away, as New Year is knocking on the door, another 2 weeks, 3 weeks, and the festive season begins to fade. And how durable is this high growth that we've seen? Now, are these low prices or low inflation a sign of efficiency or of unused capacity? So what's the cause of this low inflation, and will that sustain? Also, can growth translate into enough jobs for a rapidly expanding workforce? The question here is, the economy is growing, but is the country hiring? And how exposed is India to external shocks if the global conditions deteriorate further? We have seen how the Trump tariffs have impacted us. So far, we have weathered that storm, whether we can continue to do so without impacting the economic growth. Now, we took all these questions to the big banker who used the Goldilocks phrase, RBI Governor Sanjay Malhotra, and I joined my colleague MG Arun for a rare interview with the governor at the RBI headquarters in Mumbai. In this wide-ranging conversation with us, the RBI governor explained why he believes India is in a Goldilocks moment. More importantly, the governor talked of what it will take to ensure this phase doesn't remain a brief interlude like a fairy tale. It should have a happy ending, and it should become a foundation for sustained inclusive growth in the years ahead. Listen in to this exclusive India Today interview with RBI Governor Sanjay Malhotra. It's been a year since Mr. Sanjay Malhotra took charge as the Governor of the Reserve Bank of India. It's a year in which the central bank has had to walk a fine line between sustaining growth and safeguarding stability. In that time, Governor Malhotra has pushed the envelope on several key fronts. And we are delighted that Governor Malhotra has agreed for a special interview with India Today magazine. I'm Raj Chengappa, and this is my colleague MG Arun. Governor Malhotra, welcome to India Today.
Thank you very much. It's my pleasure to be here.
Now, you described this phase as the Goldilocks period for the Indian economy. From a central banker's perspective, how real is this sweet spot?
This has been rather eventful and a challenging year with all the geopolitical events, tensions, the trade fragmentation that we witnessed. Despite these external headwinds, India in the first 3 quarters, for which we have data in this calendar year, has done remarkably well, both in terms of inflation. We are in historic lows, as you mentioned,
right.
And even so, in growth, about 8% on an average for these 3 quarters. So we are certainly, in a sweet spot. Going forward, this year we are projecting a growth rate of 7.3%. Next year, Q1 and Q2, we are projecting a growth rate of 6.7 and 6.8%. Frankly, it's very difficult, to precisely forecast what the numbers will be over a long period of time. But yes, I think this sets the stage for India to do well, both in terms of inflation, which has been quite low, which has been rather benign over the last 2 years, in fact.
Well below your 4% comfort zone.
It's well below the 4%. And of course, the low number that you see today is primarily because of the base effect, because of the volatility and the very high food prices and inflation that we had a year ago.
Right.
But otherwise, if you look at core inflation, look at core ex-precious metals, it has been rather benign, from the beginning of 2024. In fact, 2024 till now, the monthly numbers inflation has been, hovering between the range of 2.5 and 3.4%. So inflation has been rather benign. And if you look at it structurally over the years, post FIT, we are witnessing a lower inflation, average 4.9% in the 9 to 10 years post the inflation targeting regime that we introduced in 2016.
Yes.
Before that, it used to be almost about 7%. So it's been a 2% decrease, almost a 2% decrease.
Right.
And if you look at the last 2 years, as I was mentioning, it's been in the range of 2.5 to 3.4. So I do believe that going forward for long periods, while there will be shocks, supply side, primarily supply side shocks, but as a result of a number of measures which the government has taken, which the RBI has taken, as a result of which expectations are anchored, supply chains are now much better managed, inflation is going to remain benign for a long period of time, barring supply side shocks, as I said.
I just want you to elaborate on this Goldilocks word that you use. It's a very curious phrase. It's a banker's phrase.
When we say Goldilocks, in economics terms, it is, the balance of the growth and inflation. So generally, high growth means high inflation,
right.
And low growth, and low growth can mean, low inflation. But we are having the best of both the worlds. We are having, low inflation and high growth. So that's a very sweet spot, to be in.
Right.
Governor, given that, as you said, that we are in a Goldilocks phase, the next question naturally comes, how do you sustain this?
So it's not, one single factor which has played out in this moment, and we have been, in this kind of a period when you talk about growth for quite some time now.
Yeah.
So if you look at last 4 years, the average growth GDP is about 8%.
Yeah.
Post COVID. If you look at the last decade, we had an average growth of 6.6%. Now, this is a result of a combination of measures that the government and the central bank has taken, over the period of time. Number one, most importantly, it is, I think, the policy stability that has been provided, certainty, because, that's very important. Of course, now some external uncertainties are there, because of which you can see you can see some a little bit of a correction in the growth. But otherwise, policy stability, financial stability, price stability, this continued focus on growth of the government, and a number of reforms, as a result of which a number of reforms have been taken. Recently, GST rationalization was one of them, followed by the labor reforms. Number of PLI schemes have been launched by the government, focus on manufacturing, on employment, on jobs creation, and then the very solid balance sheets, both of the government, the private sector, and the households. Good capacity utilizations. So I think on the whole, you look at each and every sector, each and every area of the economy, we are in a very good phase, and that should help us in sustaining this momentum of growth going forward.
Right. I'd like to come and to something that you've really done and changed a lot. Is since February 2025, the RBI has cut the policy rate by 125 basis points. It is now points to 5.25%. That's the rate right now. This is striking because the last comparable easing happened, I think, in the cycle in 2019 or so. And that was a bit sharply slowing growth. This time rates have been cut despite GDP growth. So what changed in the RBI's assessment? And do you see this as the start of another process? Will we continue to see rate cuts, or this is it and you will now stabilize?
So if you compare, with the last time that we brought down the rates as low as 5.25%, and then, it went down even further to 4%, we were in a very different situation. It was exactly the reverse, in fact, because the growth was low and inflation was high.
Yeah, right.
And it was increasing. Headline, next year was more than 4%, about 4.8% in 2021, So we were heading into higher inflation, lower growth. This time around, we are having good growth, and we are having, very benign inflation. So it's primarily because of the benign inflation. Last time, it was low growth, which needed to be supported. Now, the real interest rates, as I was mentioning to you, the real interest rates, especially, because core X gold is quite low. Right. It's less than, it's about going forward, because monetary policy actually works forward-looking, it's forward-looking. And so the outlook is very benign, 3.5% or so. And so real rates need to be a little lower. And so that's why, we reduced our policy repo rate by 25 basis points. Going forward, monetary policy is not, preset. It evolves. We are data dependent. We are in a neutral phase. It's for the MPC actually, to decide and see what the data points to and what we should be doing from policy to policy. However, as I mentioned, I do feel that inflation should remain benign for a longish period of time. And if that is going to remain, barring, shocks on the supply side, could be weather, could be geopolitics, could be something else, then we are in for a long period of low policy rates.
One of the things is the currency issue. And, the rupee has crossed 90 to the dollar, and yet the RBI, unlike in the past, is in no rush to aggressively defend a specific level of the rupee. Is the RBI consciously allowing greater exchange rate flexibility?
On currency, you see, we have a very stable, stated policy that we do not target any level or any price band, and we let the market forces, which we believe are quite deep, to determine what the appropriate level of the rupee should be vis-a-vis whether it is the dollar or the pound or the euro or any other foreign currency. Our aim over there is primarily to curb any kind of an undue or a excessive or an abnormal kind of a volatility which we try to curb, or if there is some kind of unnecessary speculation which is getting built into the prices, then we come in. Otherwise, we let the market forces determine the prices, which in the long run we believe are quite efficient. The market is quite efficient, and so even in this round, while some currency depreciation may help exporters, the primary purpose is, it's not that we have made a conscious effort to let the rupee depreciate.
And why I asked you that, because if you see what happened the previous 4 years, I think close to 2% of the GDP was spent on shoring up the rupee and keeping it at a rate that the RBI and the government thought was fine to help India. So should Indians now get used to a structurally weaker rupee? Is that the policy going ahead, that look, we're not going to intervene, barring, as you said, major fluctuations, but generally we believe that that's the direction we should be heading to?
I don't think, first of all, I don't think there is any major change
Right.
in the policy of the RBI to intervene. As I mentioned earlier, the policy has been very stable over the last few years, and it's only undue excessive volatility that we try to reduce. Secondly, as to what levels the Indian economy should be prepared for. See, over the years, I think there is this volatility which will continue to happen, which we have witnessed even earlier. So it's not something which is new or our economy is not prepared for. I may mention that ECBs are today 76% hedged. So people are already they already factor in and they are prepared for this kind of volatility. Last 10 years, the depreciation has been about 3% on an average. 20 years, it has been about 3.4%. So it has come down. The depreciation on an average has come down. And we believe that even going forward, the depreciation levels should not be significantly different. Maybe, it should be on the lower side, given the fact that inflation now in India is going to be lower vis-a-vis the other economies. And why we depreciate is because one of the major reasons thereof is that there is there is a difference in the inflation. While advanced economies like US, they target 2%, we target 4%. We were higher than 4%. As I mentioned, we were 4.9%. So this differential in inflation will, as long as it is there, our currency will depreciate. But going forward, we are quite confident. We have a very robust, strong external sector position. We have 11 months of import cover for goods, as everyone knows. And we are about, we have 92% in foreign exchange reserves vis-a-vis our short, vis-a-vis, our debt, external debt. External debt, is about $750 billion US, and we have about $690 billion of foreign exchange reserves. So we are very comfortable in meeting our external sector liabilities, whether it is on the current account, whether it is on the capital account.
FPIs have been pulling out a lot of money in the last few months. In fact, they have pulled out something like 1.6 lakh crore from the equities. And also the net FDI has been negative in September. So is this a concerning factor, given that, the markets have been always, boasting of attracting a lot of FPIs. Although we are seeing an uptrend in the domestic investors on the one side, but FDI also is a little problematic. So how does the RBI see this, and what's your perspective on this?
So I would rather concentrate on the current account first. That's more important. The current account actually over the years the current account deficit over the years, you are aware, has shrunk rapidly. Last year it was 0.6%. Now we should be about 1% or there so. Previously it used to be very high, as you are aware. So its current account is very benign, very comfortable. Should be we should be able to easily meet this kind of a current account deficit given the flows that we have on the capital account. FPIs, yes, there is a volatility, as you have mentioned. They have been rather low. On the equity side, on the debt side, we have had good FPI inflows on the net basis, and we expect that debt inflows should further continue because the Indian debt government securities should get included in some of the indices going forward, hopefully. So that's a positive for us. Similarly, gross FDI has increased while net FDI may have been almost zero last year. Gross FDI is the number actually we should be looking at from the economy point of view. Of course, for the external balance of payment position, it is the net, and the net, you are aware, is lower, still positive this year till now. That the data that we have is lower because of outward investments and repatriations, which is a healthy sign actually, which is a sign of a confident economy, of a strong economy, an economy which lets investments get repatriated when the investors actually want to. So these are good signs in the long run.
Governor, you mentioned the fact that the financial sector looks much healthier.
See, barring episodes, there can always be. Barring episodes, the banking sector is very resilient, very robust. Profitability figures are good, about 14% ROE on an average. Asset quality again is excellent. Net NPA is about 0.5%, again historic lows. Your capital adequacy is good, 17+%. Liquidity again at about 130%. On the whole, if you look at the banking sector, it's quite strong. Governance has improved over the years as a result of various measures taken collectively by the central bank, Reserve Bank of India, and the banks put together.
Right.
And regulation has further, improved, strengthened. Supervision has strengthened. We do a lot of off-site, regular, continuous, with the use of data, use of AI, etc. So supervision has become more precise. Better, has become better. It's so all these things gives us the confidence that the banking sector is much better placed today than it was 10 years ago. A lot of the credit also goes, apart from the central bank for its policies, to the central government, which cleaned up the public sector, which provided the capital for the public sector, and which improved the governance in the public sector bank. So collectively, I think over the last 10 years, the banking system has certainly improved.
You've talked of India being the fastest growing economy, large economy, and that's very good. But for the public at large, one of the things is great, the numbers look great, but are we getting the jobs that we should be getting? And from the RBI's vantage point, do you see signs that growth is becoming more employment oriented or employment intensive, or is the economy still growing faster than it is hiring?
Yes, so certainly, employment is a major factor or a major objective for any economy, while of course for us in the central bank it is price stability, keeping in view growth, which is our objective. But one can't overlook employment, which I believe over the years has been doing quite well. If you look at data, and yesterday itself data was released, monthly PLFS report that they now carry out on a monthly basis. Unemployment rate is down 4.8% or so. It used to be 5.6% as late as May, so it's come down. Even if you look at it over a longer period of time, 17, 18 and thereabouts, the PLFS, the periodic labor force participation rate, the labor force participation rate as per the PLFS, annual PLFS data, used to be in the region of about 60%, about 50%. And so from now 50%, 23-24 to 60%, it has improved, certainly. Of course, there is need. That doesn't mean, that we don't create more jobs. There is certainly, need to create jobs at a higher pace and to create jobs with higher wages going forward. And I think the economy is in good position to be able to do so.
Where does the RBI stand on the cryptocurrency issue?
See, the final view is to be taken by the government in this regard. Insofar as we are concerned, I mean, there are certainly risks, in case we were to go the crypto way. We have in our country a very good payment system, so there is not really, a problem on the domestic front, at least, which crypto solves, because our payment systems are very efficient. They are cheap, free virtually. UPI is free, and for the higher, RTGS, NEFT, they are also, available at very low costs, and some of them are instantaneous, some of them are real time, and some of them, are check, etc., next day, or now we are trying to make it, the same day. So they are very fast and affordable and efficient. So there's not really, a problem from a payments perspective domestically that they can solve. Cross-border payments, that is certainly, that can be made faster, that can be made cheaper. Our view is that CBDC and linking the fast payment systems of one country with the other is the way forward, and so we will pursue this from our side insofar as crypto and the way forward is concerned. There is a group which has been constituted by the government. RBI is a member. We have given our views over there, and a view should be taken, I'm sure, quickly in this regard.
And finally, what keeps the RBI governor awake at night as you enter your second year in it?
So it's been famously said, by a central banker, that it's the job of the central banker to worry.
It's to worry, yeah.
So we are constantly on our toes for,
right,
the various risks that can emerge from various places. External sector, for example, as mentioned, those risks continue, whether it is on geopolitics, whether it is trade fragmentation, whether it is elevated public debt levels, which can have in some of the advanced countries, which can have spillover effects, higher asset prices, again, in some of the countries, especially related to AI, which can again have, spillover effects, so technology. And domestically, of course, you have weather and climate related events, which we have to be alert to. Fiscally, you said, I think government is on a good track. They have been consolidating both center and states. I'm quite confident that going forward too, they will continue to improve their balance sheet.
Governor Sanjay Malhotra, thank you very much for this exclusive interview. For the full India Today interview of RBI Governor Sanjay Malhotra, read the latest issue of the magazine it also has an in-depth cover story on how to sustain this impressive upsurge in the Indian economy, including assessments from the Board of India Today economists. Thank you for being with me in this episode of Nothing But the Truth. I look forward to having you with me next week. Nothing but the truth.